Welcome to the Active Allocator Insight Series. We hope that educational presentations such as this one will further your understanding of asset allocation and portfolio construction. In this video, we illustrate how extending popular modern portfolio theory just does not work for alternative investments and actively managed funds. We have solved for the challenges of allocating to alternative investments, and here we show you how. So let's get started. While alternative investments such as hedge funds, liquid alternatives, private equity, and private real estate are a growing part of retail investor portfolios, what's been missing all along is a rigorous, systematic methodology for allocating capital to them. At Active Allocator, we see most capital allocators simply extend conventional mean variance optimization techniques to alternative asset allocation. We insist that this is the wrong approach, and here we show you why. Within traditional asset classes, historical returns are accurate, for they are marked to market. Therefore, volatility is an appropriate risk measure as historical returns data is, as we learnt in high school, bell-shaped or normally distributed, the common 80-20 rule. Unfortunately, alternative investments do not conform to this. Typically, traditional assets are highly liquid, for they are continuously traded. They operate in efficient public markets and exchanges. Alternative investments operate in inefficient markets. Within traditional asset classes such as stocks and bonds, there is homogeneity between sub-asset classes. Not so with alternative investments. Alternative investments are a different ballgame. Returns for some strategies are not marked to market daily. Volatility is but one measure of risk, and often a flawed one at that. Returns distributions are negatively skewed and may exhibit excess kurtosis. Different levels of liquidity restrict exit options. Fund managers often operate in inefficient markets. There is greater heterogeneity in sub-strategies. Also, asymmetric information between investors and fund managers often leads to style drift. Active Allocator corrects data for stale pricing and serial correlation. We optimize for skew and kurtosis effects. We make illiquidity premium adjustments. We incorporate extreme but rare downside events as well as drawdown periods in our algorithms. Extreme event tail risk is difficult to quantify, and downside risk capture is difficult to measure. Our research suggests that although hedge fund strategy indices are highly attractive when only mean and variance are considered, they are less so when one factors in other measures of risk, something that we at Active Allocator do. Also, given the fact that illiquid strategies are not valued properly, they tend to understate volatility. We remove serial correlation in returns. We also optimize with respect to conditional value at risk and take the negative skew into account. Illiquid asset returns series can be misinterpreted unless one accounts for an illiquidity premium. After all, tradability and redemption restrictions do limit rebalancing opportunities, as well as introduce costs of lost opportunity. Since this is a private industry, returns are self-reported, which often creates an upward bias in indices. We don't have too much control over what fund managers do after we give them our money. and managers can and do dynamically change their strategies. One needs to account for strategy drifts. Unlike pretty much everyone else, we explicitly account for these and other unique data biases. We employ techniques to help you create a more robust allocation framework. We shield you from complexity that most folks prefer to just ignore. Accurate measurement of manager performance is critical. After all, we cannot add alpha to a portfolio unless we can identify managers who generate true excess returns or alpha. However, analyzing manager performance and comparing performance across managers is often difficult because of differences in styles, in asset classes, and in lengths of track records. We have built a sophisticated approach for analyzing manager performance that allows investors to compare managers in a like-for-like fashion. But just analyzing historical data isn't enough. It's difficult to separate luck from skill, specifically problems with selection bias and short track records. We correct for these and other problems in two ways. First, we add other sources of information, such as beliefs about steady state performance. Second, we explicitly penalize managers for lack of confidence in estimates, and this leads to more reasonable forecasts of skill. To reiterate, we have created a methodology that is complex, rigorous, and thoughtful, one that challenges traditional assumptions. We address special issues, such as those from survivorship bias, serial correlation in returns, strategy drift, and historical returns distribution issues. Survivorship bias occurs when a data collector removes particular investments from the database and reports only the performance of the survivors. The end result is usually an upward bias, so we adjust the returns series downwards for this. Serial correlation is the degree to which each period's returns mirrors the results of the previous period. The major reason for this bias is stale pricing, illiquidity, and smooth returns. This artificially dampens volatility. So, we statistically remove this bias to re-estimate the true returns distribution. The notion of strategy drift involves a manager's discretionary change in investment strategy when opportunities eventually disappear in their original trades. So, we do a cluster analysis, which is a technique that seeks to group strategies that are highly correlated on a bunch of statistical parameters. We then distinguish them from groups of strategies that are less correlated. Since volatility does not accurately reflect true risk in hedge funds, we optimize for higher moments of skewness and kurtosis, as we described earlier. To conclude, the reasons why one cannot naively extend modern portfolio theory to alternative investments are many and varied. We've mentioned a few here. We address all this and much more in our algorithms. Algorithms that have been painstakingly built by MIT engineers and coded by computer science PhDs in Israel over 3 years. We encourage you to take a test drive, build a few model portfolios, and see how Active Allocator might be useful for your clients. Thank you for listening in.